Have you ever trusted the wrong person with your money? This happens all the time with whole life insurance. It's so important to know the different options that are available. The thing is, people usually don't know where to start. And the reason why is because if I say that I want a whole life insurance policy and I want to put money into it to have as much cash value as possible, there's so many different life insurance companies to choose from. How do I pick the best one? If I pick one of those companies, I might see 10 different whole life insurance products available with that one company. And then when I pick one product with that one company, there's 100 different ways I can design that policy or set it up. That's so overwhelming. Like the options are infinite when I really just start to multiply things. So how do I get the best option for what I'm trying to accomplish, which is to get as much cash value as possible? Today, we'll cover exactly that. Someone recently reached out to us and he was at the point where he was approved for a whole life insurance policy with another agent. He was about to sign, but he reached out just to get a second opinion because to him, something just didn't feel right. He felt like he was being pressured from what he had researched. They were telling him things that didn't add up. He reached out, and it was a good thing that he did, and you'll see why in a moment. So his goal was to get a whole life insurance policy with as much cash value as possible. He also wanted to fund his policy for 15 years. We're going to focus on MassMutual because he was shown a MassMutual Whole Life 100 product, which is the most common type of whole life insurance product that is sold with most life insurance companies. It's a traditional, old school whole life insurance policy. The 100 means that's how long premiums are due for. He doesn't have to pay that long as he's only going to pay for 15 years. So we are going to start by looking at the policy that he was shown, and then we'll look at some revisions in order to give him more value. We're going to look at different options. So he wanted to fund up to $100,000 per year, but he also asked, what's my minimum? Meaning he did not want to be obligated to write a check for $100K per year for 15 consecutive years. So the minimum really depends on how the agent sets it up. I like to refer to this as the rules of the game. Imagine if you knew what your agent knew, and then you could dictate to him or her exactly where you'd like your money to go and to make sure you have as much cash value as possible. I'll show you exactly how to do that. So there's two rules to be aware of. First, we have an IRS rule. Why people are attracted to cash value life insurance is because it's a safe place they can put their money. They can access it like their own bank or like a personal line of credit, specifically through the loan feature, and then it is tax-free as long as we follow IRS rules. That's why people put money there. That's why corporations put money there. Now, you can mess up the tax-free piece if your life insurance policy becomes what is called a modified endowment contract, or a MEC. How we prevent that, because we don't want the tax situation to occur, we prevent it by not paying in more money than what our MEC limit is. The MEC limit can be set by your agent when you first start the policy. The MEC limit is determined by your age, gender, and death benefit. The guaranteed rate also has an impact on it, but it's primarily your age, gender, and death benefit with any life insurance policy. So the first thing we want to do, if he wants to pay in $100,000 per year, I just want to make sure that my MEC limit is at least $100,000. Next, we've got the insurance company limit. When you pay money into a policy, your agent decides how much goes toward the base premium and how much goes toward what is called your PUA, or paid up additions rider. Now, I say your agent decides, but you can say no until these are set up how you want them set up. This is so important. And the thing that I'll mention is money you pay toward the base premium buys you life insurance first and gets you cash value second, whereas these PUA dollars, I call them a cash dump in because they build cash value first and life insurance second. Now, the thing in the life insurance industry is there is a huge conflict of interest because agents, like myself, are incentivized to sell the premium. And agencies will reward agents for selling more premium, mainly monetarily. That's where the money is made in the insurance industry. Now, when we look at different products, you will see them function differently. We talked about the Whole Life 100. That's the most common type of whole life insurance product that is sold, and it is also what this individual was shown. Let me show you something cool. I'll go through this quickly. Starting with the Whole Life 100 product. Your money can go toward the base premium or that PUA rider. Dollars that you pay toward the base premium with the Whole Life 100 product give you zero in cash value in the first year. With this high early cash value product, or HEC fee, dollars that you pay toward the base premium, you'll see about 80% in the first year. This product will give you the most cash value early on. Then you've got the 15 pay product. Dollars you pay toward the base premium, you'll see about 25% of your payment show up in cash value. Again, that's in the first year. And then the 10 pay product, dollars you pay toward the premium, you'll see between 30 and 35% show up in cash value in the first year. When it comes to dollars you pay toward your PUA rider, you see just about all of that show up in cash value. It's usually somewhere between 90 and 95% in the first year, and it typically produces a positive return beginning the second year. So, which one would you want? If it was upfront cash value, probably that high early cash value. Now, if you asked me which product delivers the most cash value overall, if cash value is my goal, my answer would be the 10 pay product. Mass Mutual designed their 10 pay product to focus on cash accumulation first and foremost. If we measure the returns on a policy where you're paying the same out of pocket and it's set up in the exact same manner, that option will deliver the most cash value long term. Even by the second or third year, you'll have the most. The 15 pay is going to be number 2. They also have an 8 pay, which is going to be right around or in between the 10 and 15 pay. It's usually number 2 or number 3. But then after that, you've got different products, such as their high early cash value, their Whole Life 65, their 20 pay product. And then last, when it comes to cash accumulation, is the Whole Life 100 product. This individual and most individuals are shown a Whole Life 100 product or a traditional type product with a different company. Why is that? Has to do with the conflict of interest piece I mentioned earlier. Here's what we're going to review. First, we'll review what he was shown, specifically the Whole Life 100 product from the other company. Then we'll look at the exact same product with the exact same company, but designed differently. And then we'll look at a different product, but the same design, which would be my recommended design. And as we go through that, or I should say after we go through that, what we're going to look at is the value to you, specifically focusing on the cash value, and then also the value to the agent. This way, when you're speaking with an agent, you can see exactly what their incentive is. And the purpose of doing this, and really this entire video, is to highlight the importance of getting a second opinion. And this is something that our company does. People frequently reach out to us with their existing policies or a policy they're about to start, and they want to make sure that it's being set up for maximum cash value, and in many cases, it's not. And we've got different service arrangements. If they really like the agent they're working with, we do have a fee for service available. If they want to work with us, we don't charge any flat fees as we earn a commission if we are the broker of record for the life insurance policy sale. But regardless of that, our big thing is offering this for free just to make sure people are getting the right product right out of the gates. And doing this for anyone, regardless of who you get your second opinion from, will really help prevent buyer's remorse altogether, because buyer's remorse comes up when people don't know what they're getting and they find out after the fact they did not get a good deal. So we're going to focus on 2 products, what they were shown, the Whole Life 100, and then also the 15 pay product, because the goal is to fund for 15 years with $100,000 per year. So let's kick things off with what they were shown. Here's the proposed design. Annual funding, $100,000 per year, a whole life 100 product. Where's the money going? We've got 30% directed toward the premium. This is what the other agency showed him and he was approved for, was about to start this, which means the other 70% was directed toward his PUA rider. So he paid in a total of $100,000 and his first year cash value would be about $65,000. Now, as he continues to pay that $100,000 per year, when does he finally get his money back? Let's look. 100, 200, 3, 4, 5, 6, 7, 8, 9. By the 9th year, he's paid in $900,000. He's got $924. Before that, he had a loss. When I speak with business owners and they see this kind of stuff, they express, I'm not getting whole life insurance. It's a huge lost opportunity cost. Are you nuts? I'm like, I agree. You've got to make sure you don't have the lost opportunity cost in order for this to really work in your best interest. So again, this is what he was shown. And what most people are shown with whole life insurance is something like this or a lot worse. Let's look at the revised design. So we're going to look at the exact same product with the exact same company, just designed for more cash value. And what we're going to look at here is this, the same whole life 100. The difference is that the premium is at $10,000. He's going to fund the same $100K per year for 15 years. All right, first year cash value, $83.51. You'll also see his MEC limit up here, just over $100K. Perfect, okay. He pays $100,000. His cash value, $83,000 and change in the first year. When does he get his money back? 1, 2, 3, 4, 5, 6. Year 6, he's paid in $600. He's got $598, just about there. By year 7, he is cash positive. The health rating on all of these policies, by the way, is a standard non-smoker rating. So it's not preferred or anything like that. Check this out. Here is his cash value difference, which is showing how much more or less he has in cash value with the same product, with the same company, just designed with a lower premium. The first year, it's got about $18,000 more in value. By the 15th year, he's close to $40,000 more in value, specifically the cash value. It's a huge opportunity cost if he does want to tap into it. He also has a much lower premium. Remember earlier we mentioned that he wanted to be able to fund up to $100,000, but he also wanted to know what his minimum was. With the original proposal, his minimum was $30,000 per year. He couldn't pay less than that. With the updated, it's $10,000. More money from start to finish. Why wasn't I shown this from the get-go? Can actually make it better. So what he was originally shown was a policy with a $30,000 minimum premium. We looked at that. And then we compared that with the same product, but different design, specifically a $10K minimum premium. Now let's look at a different product, but designed the same with the same $10K base premium. So we're going to look at a 15-pay product with MassMutual. We'll start with what we just looked at, the Whole Life 100 product. There we go. This is the attractive one that broke even just about by year 6. Here we go. 15-pay. Different product now. So again, same company, but different product, but same design. What that means is you're paying the same $100K per year, but we've got it maxed out. A 10% minimum premium, which with MassMutual is just about as low as we could drive it. Name of the game, push the premium down, increase the PUA, gives you more flexibility because the PUA can be adjusted up and down every year, and the PUA is also what builds cash value. That is the name of the game. First year cash value, 88%. When we look at the break-even point, 1, 2, 3, 400,000 in, $398 in cash value, so close. and you're cash positive in the 5th year. Here's the difference in cash value over time. Substantially more value. Look at that. By the 15th year, it's $142,000 more. Same company, different product, set up with a minimum premium. Same health rating, same everything else. This is where knowing your options and being aware of the different options are extremely important. He's taking his time now, which is so important. He's eager to start, but if he would have just rushed into it, that's where buyer's remorse would have occurred. All right, so we looked at that. Let's look at the value to you, which we just hit on, the cash value. The 15 pay gave you the most. But let's compare that now with the value to the agent, because this is where the conflict comes into play. And a lot of my peers don't like this, and I understand it, but it's people's money that we're dealing with. A little bit of backstory. When we look at how compensation works, throwing compensation out the window for a moment, what I always found is policies designed with the lowest premiums give the consumers the most cash value on a guaranteed basis. In the majority of cases on an illustration, the most non-guaranteed cash value. But then we've got the unseen element, which is actual policies that have lived the test of time. We track policies that we actually write and policies that have been started before I was born. And I've got to see firsthand which policies produce the most value for consumers. And the policies that we see produce the most value are the ones with the lowest minimum base premium. Here's why that's important. Mass Mutual, we're going to look at the commissions. These commission rates are based on exactly what I would make. On the base premium, BP, the first year, I make 93.5% with the Whole Life 100 product. It is specific to that product. That could actually be greater than 95%. We don't push it all the way up, mainly because the agency we work with is great with customer service, and I want to keep it that way. PUAs, 2% they pay in commission, so much less. Now that base premium of 93.5% is only in the first year. Beginning the second year through the 10th year, the renewal commission is 5%. So in the first year alone, with the option he was going to proceed with, yearly commission, almost $29,500. The total commission tallies up all of the renewals. So the 10-year lifetime value of this policy to the agent would be $55,000 over 10 years. Okay, keep that in mind. When we look at the next iteration of this design or of this product, still the Whole Life 100 product, but we shrink that premium down to $10,000, which increases the consumer value. Look at the yearly commission, $11,000 and change in the first year. And by the 10th year, the total compensation paid is almost $32,000. So substantially less than the first one, but the consumer had substantially more money. Do you remember by the 15th year, how much more he had in cash value with the 10K base premium option? It was almost $40,000. Like the difference in favor of the product with the lower premium. Look at the difference in commission. You can see where the money's going, really, when we break it down. And then when you really look at the attractive option, the 15-pay product, look at this. First year, $7,200. 10-year, LTV, $28,500. You make less over 10 years with this option than what the agent would have made in the first year alone with the proposed design they were showing him. It's like, come on. The guy expressed explicitly that he was interested in cash value. And he was actually questioning them about different products to try and maximize the cash value further. Point is, there is a big conflict of interest. And to wrap all of this up, in order to prevent buyer's remorse, what I would suggest is simply getting a second opinion. And it could be a third, fourth, or fifth. You don't want necessarily analysis paralysis, but at the same time, where so many people go wrong with whole life insurance is they get a product, because they trust the first agent they speak with. That's what happens. Then after the fact, they find out that it could have been set up differently. And that was all with a major mutual company, MassMutual. If we were to look at a smaller company, you'll find that the first-year commission can be in excess of 130% with some companies, which really stresses the importance of really digging into things and understanding how it works. So I hope this video was helpful. I'd love to hear your thoughts. If you have any questions, comments, please leave them in the comment section below. If you'd like to connect personally, feel free to DM me on LinkedIn. And if you'd like a second opinion, or if you'd like to connect with us, you can visit our website, ibcglobalinc.com, and you'll see all sorts of free resources on that website, video trainings, guides. We have a copy of my book coming out soon, which I am super pumped about. But you can also complete the contact us form and just let us know that you'd like a second opinion, and we would be happy to review the policy. And I will say, if you've got a good policy, we will let you know that. And if it doesn't make sense to make any adjustments, we will also let you know that. Hope this helps. We'll talk to you in the next one. Thanks so much.